The U.S. markets are currently closed for trading. Plug Power Inc., trading under the ticker symbol PLU, finished the most recent session on October 8, 2025, at a price of $3.66 per share. This represented a significant intraday drop of $0.21, marking a sharp 5.56% decline for the day. Now, a move like that, a more than 5% haircut in a single session, is the kind of event that triggers alerts on every trading platform, from the Fidelity mobile app to a professional setup with interactive brokers. The immediate reaction for many investors, especially those managing their own portfolios through SoFi Invest or Robinhood, is often a gut-level fear. But to only see that percentage drop is to miss the far more important story unfolding just beneath the surface. What the headline number doesn't tell you is how the character of the trading volume has changed in the last 10 sessions, or the specific derivative bets being placed against the company that suggest some large players are positioning for a key event within the next quarter. This isn't just market noise, it's a signal. The general expectation surrounding Plug Power has always been one of grand, long-term vision. This is the poster child for the hydrogen economy, a company that for years has been presented as the key to decarbonizing heavy industry and logistics. Investors bought into the narrative that its fuel cells, powering forklifts and warehouses for giants like Amazon and Walmart, were just the beginning. The real prize was its vertical integration into green hydrogen production itself, creating the fuel, not just the engines. The belief was that as the world inevitably shifted towards cleaner energy, Plug Power would be sitting on an essential piece of the infrastructure, making early investment a ground floor opportunity. Many people performing online investing have seen it as a speculative but potentially massive winner. However, the operational reality on the ground paints a much more complicated and urgent picture. That 5.56% drop wasn't an isolated incident. It's part of a brutal, protracted downtrend that has seen the stock fall from highs of over $70 just a few years ago. The difficult truth is that the company's fate is no longer just about the promise of hydrogen. It's about the harsh mathematics of cash burn, negative gross margins, and a desperate race against a ticking clock of financing. The company isn't just competing with other hydrogen hopefuls. Its primary competitor is the status quo and the relentless improvement of lithium-ion battery technology. Every quarter that Plug Power fails to achieve positive gross margins, the battery alternative gets cheaper, more efficient, and more entrenched. The reality is that Plug Power is fighting a war on two fronts, one against the fossil fuel past and a much tougher one against a battery-powered present that is proving incredibly resilient. Let's dissect the recent price action more closely. That single-day decline was accompanied with trading volume that was roughly 130% of its daily average over the past 3 months. This isn't passive selling. Elevated volume on a sharp downward move indicates conviction among sellers. This wasn't a slow drift lower, it was an aggressive push. Digging into the order flow, we can see that large block trades, characteristic of institutional funds adjusting their positions, were skewed heavily to the sell side in the final hour of trading. This is the kind of activity that dedicated traders on platforms like interactive broker systems pay close attention to. It suggests that at least one major fund decided that holding its position through upcoming economic data releases or a potential company announcement was a risk it was no longer willing to take. This is a far cry from the small lot selling often seen on a Robinhood stock trading feed. Furthermore, the options market is telling a fascinatingly bearish story. Open interest in put options, contracts that profit if the stock price falls, with expiration dates in the next 45 to 60 days, has surged. Specifically, the strike prices at $3 and $2.50 have seen a disproportionate amount of activity. This isn't just hedging. This is directional speculation, a clear indication that a segment of the market is betting on or protecting against another significant leg down. While some use Fidelity ETFs or mutual funds to get broad exposure to green energy, these options traders are making a very specific and very negative bet on Plug Power's immediate future. This is a stark contrast to the fervor we saw a few years ago when call option volume dominated, with retail and institutional investors alike chasing the stock's meteoric rise, hoping to find the next Tesla stock or Nvidia stock. For those considering an investment, or for current shareholders wondering what comes next, it's essential to understand what Plug Power actually does. At its core, the company designs and manufactures hydrogen fuel systems. Its primary market has been in material handling, powering fleets of forklifts in distribution centers. The appeal is straightforward. Unlike batteries that need hours to recharge, a hydrogen fuel cell can be refueled in minutes, maximizing uptime. The business model involves selling the hardware, the fuel cell units, and, crucially, signing long-term contracts to supply the hydrogen fuel and provide maintenance. This second part was meant to create a stable, recurring revenue stream. More recently, the company has made a massive push into producing green hydrogen itself through electrolysis, with the goal of building out a national network of production plants to supply its customers and sell on the open market. This expansion is where the expectation versus reality gap becomes a chasm. The expectation was that building its own hydrogen supply would insulate it from price volatility and create a highly profitable, vertically integrated energy giant. The reality is that building these plants is extraordinarily capital-intensive. It requires billions of dollars, and Plug Power has been financing this expansion through a combination of debt and, more painfully for shareholders, the issuance of new stock. This dilution puts constant pressure on the share price. Every new share issued makes each existing share worth a smaller piece of the company. Their financial reports have been a chronicle of this struggle. Revenue has grown, yes, but losses have grown even faster. The company consistently spends more to produce and deliver its products and fuel than it makes from selling them, leading to negative gross margins, a financial red flag for any manufacturing business. Investors using Schwab intelligent portfolios or similar robo-advisors are often shielded from this kind of single-stock risk. But for those engaged in self-investing, this is a critical detail to grasp. I'm interested to see how current investors are navigating this. Comment below with how many years you've been holding your Plug Power shares. It will give us a good sense of how many are long-term believers versus recent speculators. Looking ahead, the path for Plug Power is fraught with both potential catalysts and substantial risks. The bull case, the scenario where reality finally starts to catch up with the long-held expectation, hinges on a few key developments. First and foremost is achieving positive gross margins in its core business. The company's management has repeatedly promised this is just around the corner, but they have to deliver. A single quarter showing they can actually make a profit on their equipment and fuel sales would fundamentally alter the investment thesis. Second, government support is critical. Tax credits from legislation like the Inflation Reduction Act are designed to make green hydrogen economically competitive. If these credits begin to flow in a meaningful way, it could provide a significant financial tailwind. Finally, the signing of a new massive-scale deployment contract with a major corporation could restore confidence and provide a much-needed revenue boost. Conversely, the bear case is simply a continuation of the current reality. The biggest risk is the balance sheet. The company's cash reserves are finite. If the burn rate continues at its current pace without a clear line of sight to profitability, another capital raise through share issuance becomes almost inevitable, leading to further dilution and a lower stock price. Execution risk is also a major factor. Building complex hydrogen plants on time and on budget is incredibly difficult. Any significant delays or cost overruns could be disastrous. Lastly, there's the competitive threat. If battery technology continues to improve and costs come down, especially for industrial applications, it could erode Plug Power's primary value proposition of rapid refueling. Big players in the tech and auto sector, like Apple stock and Tesla stock, command massive research budgets, and spillover from their battery advancements could impact the entire energy storage landscape. For anyone looking for investment help, understanding these competitive dynamics is essential for any long-term thesis. So, when we circle back to that 5.56% drop, we see it not as a random fluctuation, but as the market's real-time pricing of these competing forces. The expectation of a future hydrogen economy remains a powerful story. It's a vision of clean, abundant energy that is easy to believe in. But the present reality for Plug Power is one of immense financial pressure, operational challenges, and fierce